Welcome to this lesson on pricing strategies. Pricing is one of the most critical marketing decisions, and one which requires awareness of your markets, your competitors and your products and services. In this lesson, we will look at the range of pricing options open to businesses, and steps you can take to optimally price your products to ensure profitable growth. So let's start this exploration. Pricing reflects the generic strategy you are employing for your products, which we looked at in the preceding presentation. But pricing can also reflect other variables. In this section, we will look at pricing strategies that can be used for new and for existing products. If your offering has enough differentiation to justify a high price, and you desire quick cash, and have minimal desires for significant market penetration and control, then you set your prices very high. This is known as a skimming strategy. This approach is commonly used at the launch of new products or services, which have a unique value proposition to put to the market. If near-term income is not so critical, and rapid market penetration for eventual market control is desired, then you set your prices very low. You need to ask yourself, should a product be launched with an aggressively low price from the start, a penetration strategy, or should the product be introduced at a high initial price, with subsequent price reductions, as the market matures, as in a skimming strategy? A market share-focused penetration strategy is most appropriate when it is important to exploit a first-mover advantage, or to quickly establish a broad installed base in anticipation of 1. Cost improvements from scale, scope or experience, or 2. Substantial complementary product sales. For example, razors and blades, or toner cartridges for printers and copiers. Or 3. Subsequent upgrade cycles, such as with software. There are 3 types of common pricing strategies for existing products or services. The first is the price leader strategy. This is the price set by the market leader upon which other companies base their prices. Companies that take their prices from the market leader are known as price takers. This is sometimes called comparative pricing. The third is the predator. Predator pricing strategies are used to force your competitors out of the market. They are normally short-term, and only available to companies with extensive resources. There are, of course, many characteristics of your products or services which can influence price decisions. Does your offering provide tangible versus intangible benefits or differences? Offerings with immediate and tangible benefits will usually support higher prices. Another factor which will influence pricing decisions is the uniqueness of your offering versus the competition. Uniqueness usually supports a higher price if the offering has credibility. Another factor is whether your offering is one of several in a product or service line. Pricing must be consistent with the rest of the line. An additional factor is whether your offering is a complement to another product or service. Sales to existing customers usually reduces marketing costs, thus giving greater pricing flexibility. Let's ask a few questions to help you think through your pricing decisions. Is this a new or existing product? Does this offering require a short-term or a long-term commitment? That is it a pet rock sort of offering, or is it something you can build a business around? Do you need to maximize cash flow? If so, are you willing to set your price high to get the greatest return from each sale at the cost of limiting market share? Then skimming would appear to be the best pricing strategy. Is it your intent to capture maximum market share, or attract customers for sale of other offerings? If so, are you prepared to take a loss on the sales of your current offering, to build a customer base that will purchase a follow-on, and potentially much more lucrative offering, in the future? Do you want to price to set entry barriers? If so, you must decide whether a low price, that still makes you some profit, will discourage the entry of new competitors. Is it important to attract attention to the product or service? Will volume sales establish a brand recognition, and if so, is this more important in the short term, than concern for whether any profit is realized? Let's now consider the predator pricing strategy. Do you want to price to hurt competition? If so, are you willing to lower prices enough to ensure that you will increase your market share? Are you willing to significantly underprice the competition, to sell in volume, generating some cash, but destroying future market potential by lowering price expectations? If so, then the predator pricing strategy is what you are looking at. Let's look now at the price taker. Are certain price levels necessary to retain customer base, channels of distribution? This may be a factor if it is your intent to remain in the market over a long period of time with numerous offerings. In this case, it may be prudent to maintain low prices. Do you have excess inventory? If so, is break-even or even a loss on each sale more cost-effective than having the offering sitting in inventory due to interest payments, storage costs, or time-sensitive materials? If so, a price-taker approach is required. Now we suggest you take some time to review your products or services and assign a pricing strategy based on your initial analysis. You will find a template in your manual with some additional guidelines. Whatever you charge for your product, the price must accurately reflect the way your customer values your offering. If a customer thinks your price is too high, expect one of the following: the customer won't buy. The customer will buy, but won't feel satisfied about the value. Meaning you win the transaction, but sacrifice the customer's goodwill, and possibly, the chance for repeat business. The customer will tell others that your products are overpriced. If your prices are on the high end, though, just be certain that the quality, prestige, and service that you offer is commensurate with your pricing. Then again, if a prospect thinks your product is worth more than its price tag, you may sacrifice a sale if the prospect interprets the low price as a reflection of a second-rate offering. You may make the sale, but at a lower price and lower profit margin than the customer was willing to pay, leaving money in her billfold and possibly a question mark in her mind. The customer may leave with the impression that you are a discounter. Unless you really want to try to own the bargain basement position in your market, you're better off providing excellent value and setting your prices accordingly. During the split second that customers rate the value of your product, they weigh a range of attributes. What does it cost? What is the quality? What features are included? Is it convenient? Is it reliable? Can they trust your expertise? How is the product supported? What guarantee, promise, or ongoing relationship can they count on? If your product's quality and features are only average, then they'll expect a low price to tip the deal in your favor. On the other hand, if customers place a premium on your promise of reliability, they'll likely pay the higher price. Knowing your product and service's value proposition can help you formulate pricing strategy. We suggest you take some time to rate your products according to the customer value equation using the template in the manual. We also suggest you give your prices an annual checkup. Here are the factors to consider and the corresponding questions to ask. Your price level. What is the perceived value of this product compared with its price? What are the prices of competitive products? How easily can the customer find a substitute, or choose not to buy at all? Your pricing structure. How do you price for extra features/benefits? What features or benefits do you include at no extra charge? What promotions, discounts, rebates, or incentives do you offer? Do you offer quantity discounts? Pricing timetable. How often do you change your pricing? How often do your competitors change their pricing? Do you anticipate competitive actions or market shifts that will affect your pricing? And do you expect your costs to affect your prices in the near future? Pricing is of course also informed by the product stage in the product life cycle. Products get old. They follow a life cycle that begins with product development and proceeds until the product reaches the point where it is old, at which time its growth rate halts and profits decrease. The descriptions which follow explain the marketing steps and sales expectations that accompany each phase of the product's life. At the introductory phase, marketers seek to build awareness, interest, and market acceptance while working to change existing market tendencies. They will use introductory offers that motivate prospects to try the product. There is a need to drive sales to speed up your cost investment recovery. Though it is tempting to drive early sales through low pricing, be careful because that first impression will stick and limit your ability to increase price later. We suggest you set the price where it belongs relative to your product value, and gain sales through introductory offers and heavy startup advertising. The product enters the growth phase once it is adopted by the first 10 to 20% of the market, known as the market innovators or early adopters. The masses follow this pace-setting group, and when the masses start buying, growth takes off. At this point, competitors enter. Here you may adopt premium pricing. However, you may also want to consider promotions and special offers to protect and build market share. When the product reaches maturity, its sales are at their peak level and sales growth starts to wind down. At this point, you will typically need to adjust your pricing down to match the competitive intensity in the market. The market may also be saturated at this point and flooded with options. Sales may come largely from replacement purchases. Pricing offers and other incentives are now needed to recruit new customers and win them from competitors. Finally, when the product reaches the depth of its sales decline, a business has several choices. One is to abandon the product in favor of new opportunities, perhaps introducing phase-out pricing to hasten the cycle closure. Another is to let the product exist on its own, with minor marketing support and, as a result, minor sales expectations. Yet a third option is to reinvent the product's usage, application, or distribution to gain appeal with a new market. There are a number of activities to complete for this unit. Take the time to complete these in your manual. In this way, you will better learn from and retain the knowledge covered in this unit. Price decisions are critical to your success. Price too low and you risk entering an ever-increasing spiral of decline. Price too high and your sales potential may be lost to competitors. Pricing is dynamic and requires your constant vigilance. You need to continually monitor your markets, your competitors and your customers. By applying a strategic and value-aware approach to pricing, you will have a much better chance of profitable growth and survival in times of economic recession. Many thanks for watching this lesson. Want to learn more? Click on our website to view our range of courses on marketing and sales management.